Good day. My name is Ed Garruto. I am here with Anthony Massaro and Ted Massaro, and we are advisors with M Financial Planning Services in Marlton, New Jersey. M Financial Planning specializes in independent, comprehensive planning for individuals and businesses. Today, we wanted to talk a little bit about navigating stock market volatility in a coronavirus world. So, our agenda, I'm going to cover current shocks in historical perspective. Anthony's going to talk about what's going on in our heads, and Ted will give us some advice for living with market volatility. Let's get started. With all the events in the news and related market volatility, investors may be wondering, how are these events impacting my investment? This chart shows the growth of the S&P 500 index over the past 10 years through April 30th, 2020. The S&P 500 index measures the stock performance of the 500 largest companies listed on stock exchanges in the United States. It is seen by many as a representation of the U.S. stock market, and we will be referencing it throughout this presentation. The average return of the S&P 500 index over the last 10 years has been 11.7%. As you can see, up until recently, we've been fortunate to experience a bull market, and some investors who've just started investing recently have never experienced a significant downturn. It's not surprising that investor emotions are running high. Here we are today. Let's review how recent shocks are impacting the market. On December 31st, 2019, coronavirus disease was first reported from Wuhan, China. On January 20th, 2020, other countries, including the United States, confirmed cases. On January 30th, the World Health Organization declared an international public health emergency as cases were reported outside of China. 3 days later, the first coronavirus death was reported outside China. On February 24th, the U.S. stock market plummeted over coronavirus fears. On March 11th and March 12th, the World Health Organization declared COVID-19 a pandemic, and the S&P 500 entered bear market territory, which means a decline of more than 20% after President Trump announced a travel ban on most of Europe, which raised the prospect of worldwide economic slowdown. On March 23rd, the Federal Reserve announced new measures to support the economy. March 25th, the UN, the United Nations, issues a $2 billion global humanitarian response plan. April 8th, Wuhan lifts its 76-day lockdown. April 16th, President Trump issues guidelines to states aimed at reopening parts of the economy. And on April 28th, 2020, U.S. cases rose above 1 million. U.S. jobless claims reached an all-time high. The combination of the coronavirus outbreak and oil price reductions is unprecedented, and it's still too early to tell how this will impact the economy over the long term. However, we do know that volatility can cause investors to act on their emotions, and that lessons learned from the past can help in navigating these uncharted waters. To put the current shock into historical perspective, we know that while most investors know the market goes through cycles, it's in times like these, when markets are stormy, that emotions are running high. A historical view focusing on relevant research, solid data, and proven strategies can help put current events into perspective. While the past is not predictive of the future, it does offer a valuable perspective. Let's take a look at the past. This chart shows the growth of the S&P 500 index since 1970. It illustrates the history of bull and bear markets. Again, a bear market is defined as a 20% decline from peak. A bull market starts when the previous contraction has reached its maximum drawdown and continues until another 20% decline or more. The recent market contraction by the above definition ended on March 23rd, 2020. However, it's still too early to tell how long this crisis will last and what kind of recovery may follow. Take a look at the big picture. Can you draw any conclusions? As you can see, bull markets have lasted longer compared to bear markets, and the average gain during a bull market was larger than the average loss during a bear market. Bull markets have an average length of 7 years and 4 months and an average growth of 397%. Bear markets average about 13 months in length with a 42% decline in the market. The history of bulls and bears tell us that market declines are just a part of investing. They are inevitable, they happen frequently, but they don't last forever. Market corrections of 5% or more have happened once every 10 months. A market correction of 10% or more has happened approximately every 2 years. 15% or more has happened once every 4 years. And a market correction of 20% or more, which is considered by many to be bear market territory, has historically happened on average once every 8 years. However, as you saw on the bull and bear chart, following each historical correction, the market has bounced back. Let's take a look at some of the other viral epidemics that we have faced. In 2003, SARS saw 8,000 people infected. It was brought to an end by good hygiene and environmental factors such as warming temperatures. It burned out when enough people became infected to build an immunity to the disease. In 2009, you may remember the swine flu. In 2014, we had Ebola in West Africa. And in 2018, there was a reoccurrence of Ebola, but treatments developed from the first outbreak were offered to patients. In 2015, there was the Zika virus. And that brings us to today. There is nothing exactly like this COVID-19. It's unprecedented, and it's different. It's different than past epidemics and past global economic crises in that it has caused a global economic disruption, triggering responses by governments around the world. It has severely restricted economic activity and travel globally, and we're still not sure how it will all play out. At the end of the day, we are all emotional beings. When volatility strikes, many of us feel like we're on a roller coaster. So let's find out what's going on in our heads and why. Anthony will help us with that.
Great. Thanks, Ed. Great presentation. So guys, appreciate you taking the time with us here today. What I want to go through right now in these slides here is like Ed said, what's going on in our heads and how emotions can impact on how we respond to volatility. At the end of the day, we are all emotional beings. And when volatility strikes, many of us feel like we're riding a roller coaster. So let's find out what's going on in our heads and why. So here's what's going on in our brains. When we make decisions, our frontal cortex processes lots of information to make a logical and informed decision. Usually we can do this quite well. What to eat, what clothes to wear, what kind of toothpaste to buy, the quickest route to work, etc. Then there's this little part of our brain known as the amygdala. It's often referred to as a reflexive brain because it connects the stimuli in the world around you to experiences. So while our frontal cortex gives us a logical response, our reflexive brain acts on emotions. To best explain this, let's look at an example. Remember the caveman? The amygdala may help when confronted by a saber-toothed tiger, a stimulus. Based on past experiences, the amygdala would tell the caveman that now might be a good time to run. In fact, the amygdala is often associated with fight or flight responses. But letting our reflexive brain control our reactions when making financial decisions may lead us to undesirable outcomes. First concept I'd like to discuss is a behavioral bias called anchoring. Anchoring is a tendency to focus too heavily on one piece of information when making decisions. Anchors have a powerful hand in our decision making and can create unrealistic expectations for investors. This study asked investors to tell us their average annual portfolio expectations over a 5-year period, and the median response was 10%. But when presented with a hypothetical market that was up 20% in any given year, investor return expectations shifted to a median response of 20%. The introduction of the hypothetical 20% anchor caused investors to abandon their original return expectations and expect stronger returns in the future. Later, when those same investors were presented with a hypothetical market that was down 20%, the median return expectation was positive 3%. Surprisingly, investors expected to outperform a down market by 23%. Now let's see how anchoring can influence the way we feel about our investment plan. Imagine investing $10,000 in 1989 and setting a goal to earn 8% average annual return on your investment portfolio. Here's the goal you've set. And if you can earn a consistent return over the time period, the growth of your account will look like this. And you have an ending account value of over $100,627. But the reality is the fact that things don't move in a smooth fashion. And after a few years, when the market hits a new high point, it's easy to have an anchor to return at higher expectations. If the market drops, you may feel like you've lost, losing sight that you're actually still on track to reach your long-term goal. It's important to keep focused on your long-term strategy and not let anchoring that may come with short-term volatility steer you astray. Loss aversion is another fear-induced behavior many investors experience. It can be defined as our preference to avoid losses because the associated pain is much more intense than the reward felt from a gain. In fact, studies have shown that the pain from a loss is almost twice as strong as a reward felt from a gain. As emotional investors, we tend to make decisions to avoid the pain of a loss. For example, when the dot-com bubble burst, investors panicked and pulled their money out of the market. This contributed to an increase of $491 billion moving into cash during this period. The similar movement occurred during the global financial crisis just a few years later, with investors piling $943 billion into cash. To avoid more losses in today's markets, investors may be tempted to move their investments to a place they perceive as a safe haven now. But what emotional investors may not realize is that this security comes at a cost. If you look at the average money market account yield since 2000, you'll see that while yield bounced between 1% and 4% during the first quarter of 2008, it's been close to zero for the past decade. You may be surprised to learn that once inflation is factored in, staying in investments that you may consider more secure, while they may out stock market volatility, may in fact lead to erosion of their purchasing power. Over the past 19 years, average money market account yields on an inflation-adjusted basis were only positive about 15% of the time. The positive yields in 2009 and 2015 were largely due to periods of deflation. Now I'm going to turn it over to my father. He's going to talk more about living with market volatility.
Anthony, that's very good. Appreciate the input. And at this time, I'm going to start talking about living with market volatility. As we've seen, market volatility is a natural part of investing. So what can we do today? Let's look at 3 strategies that can help investors live with market volatility. One is we want to stay calm. Obviously, that sounds easy to do, but first and arguably the most important concept of investing is to stay calm and keep a long-term perspective. The next thing to do is to consider the long-term perspective as far as your investment timeline. As you'll see on this chart, over the last 50 years, there have been multiple occurrences of market volatility during that timeline. However, if someone had stayed fully invested with that $10,000 investment for that 50-year period, they would have averaged in excess of 10% per year with a total return of over $1,300,000. The next slide talks about how often we hear all types of noise in the markets today. Obviously, the importance of keeping focused on the long term is very, very critical. Tuning out the noise is also very important. As you know, if you are investing for a 10-year period and you were looking at your statement every month, you would witness 37% of the time losses during that 10-year period. However, during that same 10-year period, the market had experienced 91% positive returns over that period of time. During your regularly scheduled review of your portfolio with your financial advisor, focus on your investment goals. Discuss with your advisor your portfolio results in terms of your goal attainment and time horizon. The next slide, we talk about diversification. And here the strategy is very simple. Diversification may reduce a portfolio's overall volatility, provide a smoother ride through bumpy markets. Perhaps nothing better illustrates the need for diversified an asset allocation plan than the chart here, which shows how various asset classes performed on a year-by-year basis over the past 15 years. The best performing asset classes for each calendar year is at the top of the column. No asset class has consistently offered the best return year in and year out. For example, let's look at the emerging markets. If you invested in 2005, 2006, and or 2007, you'd be feeling pretty good about it. But what if you had put all your money into the emerging markets in 2008? Obviously, you would not be feeling as great today for that experience you incurred in 2008. On the next slide, what we'll show is how you attempt to time the market doesn't make sense either. Let us consider 3 strategies. Some investors may choose to chase the winners. That is, they invest in last year's best performing asset class. Others may choose to chase the losers, investing in last year's worst performing asset class. And the last strategy is asset allocation, investing consistently across 3 asset classes in equal proportion each year. As you'll see from each of these, where overall volatility improving your chances to earn more consistent returns over time, keeping assets properly allocated across several asset classes helps to avoid the temptation to try and time the market. In addition, as markets change, your portfolio may need to evolve. Again, times of volatility offer a great opportunity to reevaluate and rebalance your portfolio's asset mix. Remember your strategy. This is another important area that we try to emphasize with all our clients. Your timeline of your emotions running high can sometimes distort your timeline for the money you're investing. On the next chart, we'll show you the importance of staying the course by staying invested. Short-term losses can trigger anxiety, but letting emotions drive your investment decisions may prove costly. One key to living with market volatility is focusing on long-term results rather than the daily bumps along the way. Staying the course may be difficult, but it also can create opportunities. In this chart, the blue bars represent the largest declines from a peak to a trough that occurred during each year. Despite all this intra-year volatility, the S&P index had positive year-end total returns in 25 of those 32 years from 88 to 2019. Volatility, while changing, can represent some of the greatest opportunities to buy going forward. Another consideration or another way to approach this investing is by using dollar cost averaging. Again, what most people are quick to agree that mustering the discipline to make purchases during a volatile market can be difficult for some. Simply putting dollar cost averaging is committing a fixed amount of money at regular intervals to an investment. Let's look at an example of a $500 monthly investment. As you can see, as you buy more shares when prices are low and fewer shares when prices are higher. In this example, your average share price for this 6-month period is $10. However, your average cost was $9.77, resulting in a greater number of shares, and also reducing the cost by about 23 cents per share. Dollar cost averaging can help reduce anxiety about the investment process. Investors should consider the financial ability to continue purchasing through periods of low price levels and economic conditions. On the next slide, what we're going to talk about here is jumping in and out of the market, or better known as market timing. It has been proven time and time again that market timing will not produce positive results. When markets become volatile, a lot of people try to guess when the markets will bottom out. In the meantime, they often park their investments in cash. But just as many investors are slow to recognize the returns to the stock market, many also fail to see an upward trend in the market until after they've missed the opportunities for gains. Missing out on these opportunities can take a big bite out of the investment returns. As an investor stays fully invested and didn't miss any of the best days, would have earned a significantly higher return than those who missed the best 10, 20, or 30-day period during that timeline. Also, another way to look at it is in market timing, as when we try to time the market, what we're trying to show you here is the best 20 days of trading versus the worst 20 days of trading. As you'll see here, in many cases, the best trading day immediately follows the worst trading day, illustrating how difficult it is to time the market. Again, staying fully invested is a critical part of long-term investing. In summary, I want to give you some key takeaways to consider. One, history has shown that while markets react to shocks in the short term, they have tended to reward patient investors over the long periods of time. Our emotions affect decision-making ability in all times of market volatility. And third, 3 strategies to live with the market volatility are to stay calm, diversify, and remember your long-term strategy. If you can set realistic expectations, you may be able to survive the market's ups and downs with a greater sense of confidence. Another way to consider this is to think about your financial advisor as your personal trainer. As you know, individuals sometimes will have personal trainers to keep them physically fit. Your financial advisor is another way of being financially fit. Again, a sudden drop in the market volatility can have dramatic implications for someone just starting their career compared to someone nearing retirement. What's important is you understand your situation and your financial strategy. For health-related goals, studies show that people who regularly work with a personal trainer, nutritionist, or a doctor are more likely to have success. Again, because a personal trainer can help you build a long-term strategy to achieve your goals, keep you motivated, and ensure you stay on track with regular training sessions. Similarly, working with a financial advisor can help you your long-term investment strategy. Keep emotions and biases in check and stay on track with regular portfolio reviews and adjustments. We want to take this opportunity to thank you for listening to our presentation today. And if you have any questions, please email via our website and contact our office if you would like to discuss this in further detail. Again, thank you for your time. Have a great day.